Hi everyone, welcome to my channel InfoCraze. In today's session, we will take up the topic Introduction to Accounting. If you are a commerce student or someone who wants to understand the basics of accounting in a very simple way, this video is just for you. By the end of this video, you will know what accounting is, why it's important, and the basic terms that form the building blocks of accounting. Before we begin, request you to subscribe to my channel for many more interesting videos in the field of finance, accounts, and costing. Now, let's get started. Let's start with the basic question. What is accounting? Accounting is a systematic process of identifying, measuring, recording, classifying, summarizing, interpreting, and communicating required information relating to economic events of an organization to the interested users of such information. In order to understand this definition better, we must focus on the key words in the statement. The key words here are identifying, measuring, recording, classifying, summarizing, interpreting, and communicating. The next words are economic events. Then we have organization, and lastly, to the interested users of such information. In order to understand the definition of accounting in a better way, we have to understand all these key words. Let's look into the keywords now. First is identify. This means recognizing the financial transactions or events that should be recorded. For example, buying furniture. Next is measure. Assigning a monetary value to the identified transaction. For example, bought furniture worth rupees 20,000, which is measured in rupees. Next is record. Writing the transaction in the books of original entry, like journal or cash book. Next is classify. This involves grouping similar transactions in the respective ledger accounts. Then we have summarize. This involves preparing statements like profit and loss account and balance sheet. And lastly, we have interpret and communicate. What does this mean? These activities involve analyzing financial statements to understand what they mean and sharing the results with stakeholders like owners, investors, government, creditors, etc. Now we will look into the words economic events. Economic events are the events or transactions that affect the financial position of a business and can be measured in monetary terms. In other words, these are the business happenings that affect money or value, like buying stock, selling goods, or depreciation of assets. Further, these events must relate to the business. Personal transactions of the owner are not included unless treated as drawings. Non-financial events like changing a manager or training employees are not recorded unless they affect finances of the organization. Then we need to understand the word organization. In accounting, organization refers to any business entity or enterprise for which accounting is done. It can be a proprietorship, partnership, company, or any other entity that carries out economic activities. Accounting assumes the business is separate from its owner, which is the business entity concept. Only the transactions or events related to the business activities of the organization are recorded. In simple words, accounting means keeping a proper record of all money-related transactions of a business or organization. Imagine you start a stationery shop. You invest rupees 10,000. Then you purchase goods worth rupees 6,000. Thereafter, you sell goods for rupees 3,000. If you don't record these transactions, you won't know whether you earned a profit, what stock is left, or how much cash you have. That's why accounting is called the language of business. It explains the financial position and performance of any business. The main objectives of accounting are to keep systematic record of financial transactions, to determine profit or loss during a specific period, to ascertain the financial position of a business in terms of assets, liabilities, and capital, to provide information to various users like owners, investors, government, and managers for decision making. So, Accounting is not just recording. It's also about analyzing and communicating information. Now, as we know the definition of accounting and the basic objectives of accounting, let's learn some basic accounting terms. The first term that we understand here is assets. What are assets? These are valuable resources owned by a business which are expected to provide future economic benefits like cash, furniture, building, or intangible assets like goodwill, patents, etc. The next term is liabilities. Liabilities are obligations or debts that an enterprise has to pay at some time in the future. These are the amounts the business owes to outsiders. Then we have capital. Amount invested by the proprietor in business is known as the capital. The next term is revenue. Amount earned by a business through sale of goods or rendering services is called revenue. It is the income earned from the normal course of business activities. The next term is expenses. Costs incurred by a business in the process of earning revenue are called expenses. These are the amounts spent to run the business and to generate revenue. And the last term that we look at here is drawings. The money or value of goods or assets which the proprietor withdraws from the business for personal use are called drawings. Hope you have understood everything that we discussed today. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. Thanks for watching.